So we have a crazy situation unfolding right now with a stock called Strive. I mean, the momentum here is just wild.
Yeah, it really is.
It's up 54.14% in just the last 5 trading days.
That is a massive move for a single week.
Right. And if you zoom out a bit, it's up over 145% over the last 26 weeks.
Just relentless buying pressure.
Exactly. It's currently closing right around $19.73. So, welcome to Market Pulse Daily. This is the deep dive where we break down the newest available price action, find the main catalysts driving the market, and figure out what it all means for you.
And we have a lot to unpack with Strive today.
We really do. But before we get too far into the weeds, I do want to do a quick shout out for our sponsor, StockOracle. Just as a heads up, this is an affiliate relationship, and we do have a 14-day trial link for them right down in the description of this deep dive.
Yeah, make sure to check that out.
And just keep in mind, as always, that AI insights and value estimates may be wrong and market data may be delayed. So please do your own research.
Absolutely.
Okay, so let's get into what actually changed with Strive. Because, normally when you buy a share of a publicly traded company, you expect to buy into a business that makes things.
Right, you expect cash flows.
Yeah, cash flows, physical products, active customers, a factory somewhere. You put capital in, the business operates, and it generates a return.
And that expectation is literally the entire basis of traditional fundamental analysis.
Exactly.
We look at the cash a business generates from its operations, and we assign a multiple to it based on how fast those cash flows are growing.
But with Strive, it's like imagine you're walking down Wall Street, and instead of a corporate headquarters, you just see a massive reinforced steel vault.
A giant vault.
Yeah, heavy security, thick concrete walls, totally silent. And someone just slapped a stock ticker right on the side of it.
That is essentially what we are looking at today.
Because Strive isn't really functioning like a traditional business. It is, quite literally, a publicly traded vault holding exactly 21,356 Bitcoin.
Which is an astonishing amount of digital assets to hold on a corporate balance sheet.
It's huge.
And timing is the crucial element here. We are analyzing these numbers in August of 2026, and the big confirmed development is that Bitcoin has recently surged past the $77,000 mark.
Right, so the underlying asset is ripping.
Exactly. The broader crypto market appears to be shifting into a major upward cycle.
So that brings us to why this actually matters. I was digging into the equity research report, and when you look at Strive's balance sheet, their total assets are sitting at $1.37 billion.
Billion with a B.
Yeah, billion. And the vast majority of that is simply the market value of the Bitcoin they hold in Treasury.
It completely dwarfs their actual operations.
Right, which I wanted to look into because with the stock moving this fast, my first thought was, maybe their core operations are driving this momentum.
Sure.
So I looked at their revenue growth, and at first glance, the percentages look incredible.
Oh, they look amazing on paper.
Yeah. The revenue for the first half of 2026 was up about 94% year over year.
Mm-hmm.
And the trailing 12-month revenue growth is this astronomical 743%.
Which sounds like a hyper-growth tech unicorn.
Right. If you just hear 743%, you think you found the next big thing. But then I looked at the absolute raw dollars.
And that's where the reality check hits.
Yeah. That 94% growth brought their first half revenue to just $5.7 million.
Right.
So we have $5.7 million in operating revenue attached to a $1.37 billion balance sheet. I mean, how does the market even process a discrepancy like that?
Well, think of it this way. You are buying this high-tech billion-dollar vault, right?
Okay.
And it just happens to have a very small, struggling lemonade stand attached to the side of it.
A lemonade stand.
Exactly. The growth percentages on the lemonade stand are massive only because they are growing from a near zero base.
Ah.
I mean, going from $100 to $1,000 is 1,000% growth.
Right. But it doesn't move the needle on a billion-dollar portfolio.
Not at all. And in their Q2 2026 earnings, that operating business actually missed revenue estimates, coming in at just $2.9 million.
Oh, wow. So if the operating business is that small, the market interpretation here must be entirely focused on the assets.
Completely. If you look at the price-to-book ratio, It is hovering right around 1.0.
Meaning what exactly for the folks listening?
It means the market is basically saying this company is worth exactly its liquidation value.
Okay, so they're looking at the 21,000 Bitcoin, subtracting the liabilities and saying, yep, that's the price.
Exactly. They are giving exactly zero premium to that 700% revenue growth on the lemonade stand.
They're just entirely ignoring the operating business.
Yeah. In institutional finance, we use a sum of the parts valuation. You value the treasury, you value the operating business, and you add them together.
Right.
Right now, the market is assigning a zero multiple to the operating side. Investors are just buying the vault.
Okay, but I have to push back here for a second. If the market is valuing Strive strictly at its net asset value, its book value, then we have to talk about the massive smoking crater in their recent earnings report.
Oh, the net margin.
Yeah, I'm looking at their recent financials, and honestly, I had to reread this number 3 times to make sure it wasn't a typo.
It's pretty shocking at first glance.
They reported a net margin of negative 11,800%.
Yeah.
They filed a GAAP net loss of over $523 million in the first half of 2026.
Mm-hmm.
In Q2 alone, they lost $257.6 million. So if the lemonade stand is losing $500 million, how is this company not immediately bankrupt?
Well, it sounds completely catastrophic on the surface, but to understand how they survive a $500 million loss, we have to look at the mechanics of the accounting rules.
Okay.
We have to demystify this headline loss because a huge chunk of it is just an accounting illusion.
An illusion. How so?
Well, of that $257 million loss in Q2, $228 million of it was purely unrealized paper losses on their Bitcoin holdings.
Oh, because of mark-to-market accounting.
Exactly.
Walk us through the actual mechanics of that mark-to-market process, because I think a lot of people get tripped up by that.
Sure. So under the accounting standards applicable to these specific SEC filings, companies that hold digital assets as intangible assets often have to mark the value of those assets to the current market price.
Right, at the end of the reporting period.
Exactly. So if the price of Bitcoin drops during the quarter, the company is required to record that drop in value as an impairment or a loss on their income statement.
Even if they haven't sold a single Bitcoin.
Even if they didn't sell a single coin. So they didn't actually lose $228 million in physical cash.
The market value of the vault just went down.
Right. The vault fluctuated downward, and accounting rules forced them to report that as if it were an operational loss.
So it's kind of like if I own a house and the local real estate market dips for a few months.
Yeah.
And suddenly I am legally required to declare on my income taxes that I lost $50,000, even though I'm still just sitting on my couch and I haven't sold the house.
That is a perfect way to visualize a non-cash paper loss. Now, it does severely impact the reported book equity on paper.
Sure.
We saw their stockholders' equity drop from $714.7 million down to $646.1 million in one quarter, mostly because of this mechanic.
Right. But if you are an investor trying to figure out if the company's actually going to survive, you have to strip away those paper losses and look at the real cash.
You have to look strictly at the operating cash flow.
The actual physical cash going out the door to pay employees, cover server costs, and keep the lights on at the lemonade stand.
Right. And their actual operating cash burn was negative $39.4 million for the first half of 2026.
Okay, which brings up a massive point of friction for me, because burning almost $40 million in cash when you're only generating $5.7 million in revenue, that is still a severe cash bleed.
It is. They are genuinely losing money on the operations.
And a lot of their peer companies in this proxy space use heavy leverage, right? They borrow billions of dollars to buy their crypto.
Yes, they do.
So if you're bleeding cash while carrying massive debt, that feels incredibly fragile.
It is fragile. But this is where Strive differentiates itself. If the leveraged peer companies are driving race cars heavily injected with nitrous oxide, Strive is driving a tank.
A tank.
Yeah, that is their true competitive advantage in this sector. It's their fundamental moat. Strive has a completely debt-free balance sheet.
Wait, completely debt-free in the crypto mining and proxy sector?
Completely. They hold $145.4 million in pure cash and cash equivalents,
Okay.
and they have only $28.5 million in total liabilities. There's absolutely no reported debt or institutional borrowings in their SEC filings.
So they are effectively unleveraged.
Totally unleveraged.
And the mechanics of that zero debt structure become critical when the market turns, don't they?
Oh, absolutely.
Because, Wall Street loves leverage when an asset is going up, but crypto is notoriously cyclical. We all remember the brutal crypto winters.
Right, and the mechanics of leverage in a downturn are brutal. If you borrowed $1 billion to buy Bitcoin and the price suddenly drops 50%,
Which it can do.
which it does, yeah, the banks and institutions that lent you that money, they don't care about your 10-year conviction in digital assets.
No, they just want their money.
They look at the collateral, they see it dropping, and they issue a margin call. You are legally forced to sell your Bitcoin to service your debt.
And because you're getting margin called during a crash, you are forced to sell at the exact bottom of the market.
Exactly. You get trapped in a liquidation spiral where your selling drops the price further, which triggers more margin calls.
But because Strive is driving the tank.
Strive can simply turn off the engine and sit there.
Wow.
They have $145 million in cash to cover that $39 million burn rate, and they have zero debt payments.
So they are never forced by a lender to sell their 21,000 Bitcoin at a loss.
Never. They can weather the storm and just wait for the winter to end. They have incredible downside protection relative to their peers.
And this safety profile seems to be exactly what is attracting serious institutional validation. Which brings us to the catalyst stack.
Yeah, let's look at the catalysts.
Because Citadel, one of the most sophisticated quantitative players on the street, just took a 7.6% stake in Strive.
That is a massive institutional signal.
And we also saw company director Pierre actively buying shares on the open market in mid-August.
Insiders putting their own capital to work is always a strong signal.
Right, so you have this debt-free structure, institutional money moving in, and usually that kind of money moving in precedes major corporate action.
It does.
Which leads us right into the sheer volume of recent SEC filings we saw in the source data. Strive filed 5 separate 8K forms in August 2026 alone.
5 in 1 month.
Yeah, August 3rd, the 10th, the 13th, the 17th, and the 24th. I want to dig into this because that feels like a flurry of behind-the-scenes maneuvering. What actually triggers an 8K?
Well, an 8K is a current report that the SEC requires public companies to file to announce major events that shareholders should know about.
Okay.
By law, under Regulation FD, they have 4 business days to file it when a triggering event occurs. So filing 5 in a single month is highly unusual.
This isn't just routine housekeeping then?
No, the triggers are strictly defined. It could be item 1.01, which is entering into a material definitive agreement.
Like signing a massive new vendor contract or something?
Right. Or securing a new facility. It could be item 3.02, which is unregistered sales of equity securities, usually meaning they are privately raising capital.
On it.
Or it could be item 8.01, which is for other events they deem important to security holders, like announcing a strategic pivot or buying more Bitcoin.
So, based on the research, while we don't have the granular text of every single filing in front of us, historically, this kind of rapid-fire filing pace points to a very active corporate development phase.
They're likely restructuring their capital or preparing for a significant acquisition.
Yeah.
But the broader takeaway is that all this maneuvering is setting the stage for their next major event.
Which is the Q3 2026 earnings report.
Exactly. This is the big upcoming catalyst.
Let's talk about the mechanics of Q3, because this is where the accounting rules we talked about earlier come back into play, but in the opposite direction.
Right. Remember that $228 million paper loss they had to report in Q2 because Bitcoin dipped? Well, the confirmed development now is that in August, Bitcoin surged past $77,000. It's up roughly 20%.
Okay, so if Bitcoin sustains these levels through the end of the third quarter, the mark-to-market accounting works in reverse.
Precisely. Those massive paper losses from Q2 are poised to violently reverse into massive gap profits for Q3.
The business impact is zero, but the financial impact is huge. The media headlines will shift overnight from Strive loses $500 million to Strive reports hundreds of millions in profit.
And the possible market reaction there gets really interesting because algorithmic trading bots, constantly scrape earnings press releases for GAAP profit numbers.
Right, they just read the raw data.
And retail investors often just read the headline numbers on their brokerage apps. They will see a company that suddenly looks wildly historically profitable.
So it could fundamentally re-rate the stock's narrative, causing the market to finally start pricing in a premium to that net asset value.
Exactly. It could completely shift the sentiment.
So it sounds like an incredible setup. You have the unleveraged tank, you have Bitcoin surging, and you have an upcoming earnings report that could mathematically look like a blockbuster.
It's a strong, bullish path.
But I have to pull our perspective back to the risk side for a second.
Yeah.
We have to look at the technical realities. Because despite this recent 54% surge into week, the stock chart is still a historical bloodbath.
Oh, the long-term chart is tough to look at.
The stock is 92% below its 52-week high. It was sitting at $252 a share. It is currently at $19.73.
Yeah, that is a massive drawdown.
And if we look at the technical indicators, the beta is 13.73, and the RSI is sitting at 88.64. Explain the mechanics of that RSI for a second, because that number seems dangerously high.
It is. RSI stands for Relative Strength Index. It's a momentum oscillator that measures the speed and magnitude of recent price changes on a scale of 0 to 100. It essentially tracks how fast the stock is rising compared to its average historical movements. Generally, any RSI over 70 indicates that the buying momentum has gone vertical.
Right. It's technically overbought.
Meaning, the stock has moved up too far, too fast, and is due for a violent pullback. So an RSI of 88.64 is extreme.
Wow.
It means the current buying pressure is historically unsustainable.
And a beta of 13.73 just amplifies that risk, right? I mean, a beta of 1 means the stock moves exactly with the S&P 500.
Right.
A beta of nearly 14 means it is 14 times more volatile than the broader market.
It's incredibly whippy.
So with a 92% drawdown from the highs, 14 times market volatility, and a massively overbought momentum signal, isn't this just a speculative roller coaster? For all the talk of a safe, debt-free tank, the stock chart looks like a bungee jump where the cord snapped halfway down.
And that right there is the essential defining tension of Strive. The balance sheet is a tank, but the equity price is a roller coaster.
So what's the real risk here?
This brings us to the ultimate open question and the thesis-breaking risk for long-term investors. The danger isn't just Bitcoin volatility. The real silent killer of shareholder value in this specific company is dilution.
Ah. Walk us through the specific mechanism of how that dilution drains value from the retail investor.
Right.
Because earlier, we established they are burning $39.4 million in operating cash, and they refuse to take on debt.
Right.
So where does the cash come from?
To fund that cash burn and to aggressively acquire more Bitcoin for the vault, Strive relies on capital markets. They use at-the-market or ATM offerings and preferred stock warrants.
So they are essentially printing new shares out of thin air and selling them to the public.
Exactly. While everyone is watching the price of Bitcoin going up on the front door, management is printing new shares and handing them out the back door. When you issue new shares, you take the total assets of the company and divide them into smaller and smaller slices. This is the precise mechanism behind why their book equity actually dropped from $714 million down to $646 million in a single quarter.
So even if the value of the 21,000 Bitcoin goes up 20%, if management prints 30% more shares to pay for their operating burn rate, the net asset value of your specific individual share actually goes down.
It creates a silent drain on the stock price. You can be 100% correct about the macroeconomic environment. You can be right about Bitcoin going to the moon. But you can still lose a fortune on Strive if they dilute you to death along the way.
That is wild.
That is the fundamental reason why the stock is down 92% from its highs, despite Bitcoin itself performing relatively well over that same time horizon.
Vault got bigger, but they printed so many new shares to build it that the value of a single share collapsed. So, weighing that heavy structural dilution risk against the debt-free safety net of the balance sheet, let's talk about the blue sky catalyst scenario.
Yeah, let's map out the optimistic path. And just to be clear for the listeners, this is an optimistic scenario, not a prediction or financial advice.
Right. What does a perfect storm look like over the next 2 to 5 years for Strive to actually recover those previous highs of $252? What mathematically has to happen for the lemonade stand to actually matter?
For Strive to reach its blue sky valuation, three distinct conditions must align perfectly. Condition 1. Bitcoin must enter a sustained multi-year bull market.
Okay, so it can't just be a quick spike.
Right. It cannot just be a volatile spike. It needs to be sustained so that those mark-to-market paper losses permanently reverse into massive gap profits, consistently growing the company's book value without any forced selling pressure.
Okay, so the asset base has to steadily compound. What is condition 2?
Condition 2 is the operating business. The lemonade stand must continue its 94% year-over-year revenue growth trajectory until it actually reaches a material scale.
So it needs to grow from 5 million to 50 million, individually hundreds of millions of dollars in recurring revenue.
Exactly, so that it's no longer just a financial rounding error compared to the Treasury. It has to generate its own positive cash flow.
Make the business real. And the third condition.
Zero catastrophic share dilution.
Ah, there it is.
Management has to fund that operational growth without drastically expanding the share count. They have to cap the at-the-market offerings.
So if those three conditions line up positively, a rising treasury, a scaling operating business, and a fixed share count, then what?
Then the market could fundamentally reprice Strive. Analysts would stop valuing it at exactly 1.0 times book value, and they'd start awarding it a growth premium.
You would transform from a highly speculative proxy play into an institutional-grade, lower-risk digital asset holding company.
They would get full credit for the Bitcoin vault, plus a multiple for the thriving business attached to it.
Okay, so bringing it all together, let's go over the three things to watch next for this stock. First, the next event.
The next major event is definitely the Q3 earnings report, where we will see if those mark-to-market accounting reversals actually hit the bottom line.
Right. Second, the confirmation signal. What should investors look for to confirm the bullish thesis?
You want to watch for continuation of institutional holding, like Citadel, and keep an eye out for more of those 8K filings that might indicate strategic, non-dilutive uses of their Bitcoin.
Okay, and finally, the main risk signal. What is the red flag?
The massive red flag would be new SEC filings authorizing further at-the-market offerings. If they announce they are printing millions of new shares to cover their cash burn, that is your signal that the dilution engine is still running.
That makes total sense. So, Strive is currently functioning as an extreme, highly polarized proxy play. It is a wildly volatile, completely debt-free Bitcoin piggy bank. The underlying operating business is, right now, just a financial rounding error compared to the massive crypto treasury it sits on.
It is the ultimate test of two things: your macroeconomic conviction in the underlying digital asset and your trust in the management team's capital structure strategy.
Which leaves us with a final provocative thought to mull over.
Oh, I love these.
If a publicly traded equity can exist almost entirely as a holding vehicle for a digital asset, valued purely on what it holds in its treasury, rather than producing a meaningful product, service, or cash flow, or we begin to permanently blur the line between a traditional operating corporation and an exchange-traded fund?
That is a great question.
Right. And as more companies adopt this exact Bitcoin piggy bank strategy to attract Wall Street capital, what does that actually mean for the future definition of a corporate treasury? It's something to think about the next time you are screening stock tickers.
It really is a fascinating structural evolution in modern corporate finance.
It really is. Well, before we head out, another quick reminder to check out StockOracle using the 14-day trial link in the description. Again, AI insights and value estimates may be wrong, data may be delayed, and we do have an affiliate relationship with them. But thanks for joining us for this deep dive. We'll catch you on the next one.